Hi, it's Gary Sherwold of GW Sherwold Associates. The Standard & Poor's 500 Index closed at its highest level of the year Friday, March 11th, and above its 200-day moving average for the first time since December 30th. It's hard to believe that just a month ago, the mood was grim, with fears over China's slowing growth and falling prices undermining investor confidence. While stocks have largely recovered from their drubbing in the first 6 weeks of the year, uncertainty and skepticism remain despite continued strong economic fundamentals. One of the fears haunting stocks in the January plunge that has persisted even during the strong rally over the past month is that surging levels of global debt would lead to corporate and sovereign defaults, plunging the world into a global recession. That frightening scenario is getting a lot of press and is likely to regain credibility if the market drops again anytime soon. But is there any truth to it? The article published in the Wall Street Journal on February 29, 2016 would lead you to believe U.S. companies were setting themselves up for a debt hangover. According to the article, companies have been borrowing too much and rigging their earnings by repurchasing their own shares instead of spending on capital improvements. The venerable Wall Street Journal is, thus, feeding into the argument that U.S. economy is headed for gloom and doom because of spiraling debt issuance by corporate America. Absent the past 3 years' share count reductions, S&P 500 earnings would have been 2% lower in the fourth quarter than what companies are reporting, says the journal. None of these things are true. Buying back shares is not financial gimmickry and does not artificially boost share prices as is implied. If a company has the cash to make stock repurchases of their own shares and believes its shares are undervalued, there is nothing bad about buying back its shares to reduce its share count. In fact, the data shows that U.S. companies have not just had enough cash flow to buy back shares and reduce their share count, but they have also been making extensive capital investments. Without share repurchases, earnings would have been 2% lower, as the journal reported, indicating that share count reduction has had only a fractional effect on boosting earnings. The argument that it is distorting earnings simply ignores the math. Moreover, it is not true that corporate debt is mushrooming out of control. It is true that companies are issuing bonds at a fast clip, with debt issuance up 9% over a year ago. It does look like companies are going into deeper debt. However, loans from banks are way down, and it appears companies are widely issuing debt to borrow and pay off short-term bank loans, which carry a higher cost. It is a way of borrowing for less. Now look at the soaring corporate assets. Yes, issuance of debt securities by U.S. companies is growing fast, but so are assets. In fact, the two are growing at a very comparable rate. According to this data going back to the start of 1970, the corporate debt-to-net worth ratio was about in line with the historical level. Notwithstanding soaring debt security issuance, this shows that corporate debt-to-net worth is actually in excellent shape. Corporate America does not seem to be in any danger of suffering a debt hangover. A debt checkup shows that corporate America is in the best shape it has seen in 3 decades in terms of covering its debt payments. This data from the U.S. Bureau of Economic Analysis shows that corporate interest coverage is actually near a record high. Not only has corporate America been buying back shares, but it's also experiencing strong cash flows relative to its debt load since emerging from the Great Recession in 2009. Despite the persistent worry that corporate America could face another debt crisis, the evidence just isn't there. Despite stories like the one in the Wall Street Journal saying that corporate America is buying back its shares and as a result not investing enough in capital expenditures, the data shows that this is untrue. Corporate capital expenditures are growing faster than GDP. The assertions that American companies are not investing and that productivity will shrink are bogus. As shown in this chart, capital expenditures in manufacturing structures, software, and research and development are all growing faster than the growth rate of the U.S. economy. The S&P 500 has had its ups and downs. Worries about corporate debt levels and whether companies are investing enough in capital improvements are just some of the concerns that have dogged investors in recent months. The fundamental economic facts, however, don't show there is any evidence to the assertion that American companies are going to be swept up in a global debt crisis. Just a month ago, investors were dumping shares amid talk of a possible U.S. recession. According to the Associated Press report after Friday's market close on March 11th, the Standard & Poor's 500 index fell to almost a two-year low. But confidence has returned as data has suggested the U.S. economy is strengthening. The S&P 500 is up now nearly 11% from February 11th, the AP reported, and the S&P 500 gained 32.62 points, or 1.6%, on Friday, March 11th to close at 2,022.19. Please contact us with any questions or to set up a meeting. And don't hesitate to share this video with people who might benefit from my work.